Do you know where your money is? And here's the reality. More is actually better when it comes to the number of funds available in your 401k. Howdy, friends. Welcome to the program. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents. We're broadcasting live here on News Radio WFLA Orlando. We'll be up on all the social media channels once we process through the video. Usually that takes us a day, so you see the program on Tuesday. So if you want the information firsthand, you got to listen to News Radio WFLA Orlando. If you want to see me, because, well, I don't know, maybe you're my mom or something, maybe my wife, then you can watch the program on social media and see me live. Well, not really live because I'll be a video. But anyway, I digress. On the program today, we've got much to talk about, including a recent study that came out that concluded that having more funds in a 401k actually produces better investment results, sort of going against that advice that has been out there for many years now about having less options. Less is more. We want less because people get confused. Well, now there's some new studies out there that really go to undermine that theory in its entirety. A lot of it is because many things have changed since that last study was published. Also on the program, we're going to talk about some of the changes that have come out of Washington involving your retirement. So some interesting things here. Let's actually start with that topic. The IRS announced that it had changed for 2020, or 2020 as we like to say, the contribution limits on your retirement account. So chief among them is the increase in the 401k limit. And so for the year 2020, next year, you will in fact be able to put away an extra $1,000 if you're over age 50 into a 401k, a 403b, or a 457 deferred compensation plan. So this year the limit $19,000. Next year it goes to $19,500. Also, the catch-up contribution, if I'm over age 50, I get to do more. That increased from $6,000 that you could do this year to $6,500. Hence, the total amount wound up increasing up to $26,000. So that's a pretty good sum of money that you can put into your retirement plan through your employer. So good stuff there. Obviously, that's a good thing because it allows you to put more away. It allows you to save more on your taxes if you're doing it on a pre-tax basis. It also allows for the power of compounding to come more into play as it relates to your money. So that means that you're going to have more for retirement. So all good things on that. Why do they do that? Why do they sort of every year, or maybe really kind of every other year, they increase those contribution limits? They do that because for the most part, those contribution limits are indexed to inflation. So when you have larger contribution limits, like you do in a 401k or 403b or a 457, then generally you wind up kind of getting these $500 bumps kind of along the way. Unfortunately, though, what that means for IRAs and Roths, because they don't have that big of a limit, the reality is that there is no change on your contribution level to an IRA. So that stayed the same, but simple IRAs, though, which are employer-sponsored plans for small businesses, that contribution limit did increase from $13,000 up to $13,500. So that was the big announcement this past week, adjusting those contribution limits for the different retirement types of plans, but unfortunately, no adjustments on the IRA. what you should be doing is, if you seek to maximize out your contributions to those types of plans, then you need to make sure that you're adjusting upward your contribution rate to your employer retirement plan in order to make sure that you hit that new maximum amount that you contribute. So good stuff there. The other interesting conversation out of Washington actually had to deal with required minimum distributions and life expectancy. Many folks that are taking required minimum distributions know that the calculation is actually determined by the Internal Revenue Service in terms of what your life expectancy is. What's kind of interesting about that, right, is that not only does the IRS know all about your finances, but apparently they also know what your life expectancy is as well. Well, they have not changed the life expectancy factors for quite some time, and so consequently, they're actually going to have a public hearing next year, early next year, scheduled for January the 23rd, to go over and to consider adjusting those life expectancy tables. Now, what that means for you is that affects how much your required minimum distribution is. So if we look at where we're at right now and what they're proposing, the life expectancy factor for a 70-year-old today is 27.4. They're proposing to increase that to 29.1 to obviously reflect the fact that people are, in fact, living longer. And what that means is that your required minimum distribution will actually go down, meaning you don't have to take out as much from your IRAs once you turn age 70 and a half. So from a percentage perspective, let's say that you had $100,000 in an IRA, you're over age 70 and a half, so you've got to take the required minimum distribution. Under the old life expectancy rules, you'd have to take out $3,650. Under the new, it would be $3,440. So the withdrawal rate is actually going down from 3.65 to 3.44 based upon the expansion of, or that change of that life expectancy. So a pretty good effect from if you're one of those folks that has to take a required minimum distribution and it has obviously an effect on your taxes, things like that, and you just like to take what you have to. The good news there is that what you have to take is actually going to be a little bit less than what the old rules were before. What kind of bugs me a little bit on this is that the IRS is finally getting around to this. They were originally requested in August of 2018 by the Treasury Department to look into this very issue. So August 2018, January 2020, like a year and a half before they actually finally dealt with it. I don't know about you, but if I was an employer and directed an employee to, hey, I'd like you to kind of do this project, I'm thinking that if the employee waits 18 months to do it, you as an employer might have a different view of that employee. But hey, it's government that we're talking about. It's the IRS, so they took their time on it, but it looks like they're finally getting around to addressing and shifting the life expectancy factors that go into calculating these required distributions. Simple reflection of, hey, people are living longer and these tables need to be updated. So certainly a good thing. It would apply to distributions that would start in the year 2021. So we're still a little bit ways off to actually have it come into play, but look for that in the road ahead. So we'll have more on that, I'm sure, as they do officially change those tables. And we'll slide to a break and come back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here. This is Joel Garris of Nelson Financial Planning. You know, We asked the question earlier, do you know where your money is? And I'm sure that's kind of a silly question to ask, right? I mean, why wouldn't you know where your money is, right? I mean, everybody has an idea of where they've got money. Well, at the end of the day, there's a lot of folks that sort of lose track of that money. And some of the numbers are going to really surprise you. And so, what happens to those accounts that are out there, those assets that are out there that people sort of forget? It becomes unclaimed property. And there's a process called escheatment that basically means that the unclaimed property winds up going back into the hands of the state in which you live in. So it no longer becomes yours. It's no longer yours. It actually becomes the government's. Kind of a neat little feature that the governments have, right? To be able to just simply take over things that, well, you haven't claimed it for a little bit, so yeah, we're going to take it. Now, they can keep it until such time as you or your heirs actually step forward and say, hey, wait a minute, that's ours. The issue there is, of course, you have to go through a process in order to claim it. You have to prove who you are and go through that process. Until such time as you do, then it's not yours, it's the state. So this escheatment process is one that you don't hear much about, but it is, in fact, a very big part of what's happening out there in terms of money. If you look at some of the numbers will be staggering. Vanguard published these numbers a few years ago and looked at the last 20 years. And according to Vanguard, just at Vanguard alone, they estimated that it was in excess of $200 million. $200 million that over a 20-year period of time went unclaimed and wound up going back to the states of record for those particular accounts. That's a staggering number when you think of it. Now, granted, as a beneficiary, as an heir, as the owner, you can go through that process, and the states do, in fact, have websites set up that allow you to go through that process and to claim that money. Here in Florida, it's Florida Treasure Hunt.gov. It's a government-driven site because ultimately it's really not the state's money. It's really the individual persons or the heirs of that individual. It's really their money. But this process of escheatment basically allows the state to claim it as their own until such time as somebody claims it. It's a big number. Vanguard alone estimates that over a 20-year period of time, they sent $200 million worth of assets back to the various states around the country. It's pretty significant when you stop and think about it. So we've got a suggestion for our listeners to make sure that they don't become subject to this, or that their beneficiaries don't become subject to this. And we see it time and time again where, beneficiaries heirs don't necessarily know, hey, he's got an account here, 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 and here. And I think it's so important that folks should sit down and take a piece of paper and really create a list of exactly where they have accounts, the name of the institution, the address, maybe even a phone number, and ideally the account number, so that if anything happens to you, people will be able to track down where those assets are. We're in the middle of helping somebody go through an estate process, and things just still keep popping up. An insurance policy here, an annuity here, a bank account here. I mean, it's amazing how often this happens, and you would think to yourself, how is it that people don't know where their money is? But the problem is that people sort of forget as they age. People get more forgetful. And in today's world, if you don't respond back, then it's viewed as unclaimed property. If you've got no activity in the account, then many institutions assume that you're no longer there. So it's important to have regular contact with the institutions that hold your accounts. Otherwise, it can very easily become unclaimed property, because if they don't hear from you for a period of time, that's what they have to assume. So it's kind of weird where you'd think, well, wait a minute, just because I haven't reached out and notified folks, hey, I'm still around, why don't they just assume that I'm still around? Why do they assume the opposite? Well, I'm not sure where that rule comes from, but they do, in fact, assume the opposite. So you've got to reach out and make sure that you're registering contact on your accounts so that this process of escapement doesn't happen, because it's a big amount of money and it's a big process that your beneficiaries are going to have to deal with. So we really highly recommend, in order to avoid this altogether, to really sit down and maintain a list of where you have accounts, where you have assets, and make sure that your beneficiaries know where that is, so that if anything happens to you, they're going to know where to go to get the information to be able to track down assets. Look, the reality is your beneficiaries, whether that's your kids, your grandkids, they don't know where you've got all your accounts at. And that's why it's so important to detail the whereabouts of all of these different accounts so that they know where to track them down. Because when you stop and look at how much money goes back to the states in this form of unclaimed property, it's staggering. And also the assumption that, hey, if you haven't contacted us, we're going to assume that you don't want the account, or you're not around, or whatever the case may be, and then we send it off to the state. And the states love that, because that's extra money for their coffers. It's not actually the state's money, but it becomes that if you do not claim it, or if you do not register contact on a regular basis. And usually the rule is about 3 years. So if you've got stuff sitting out there and you haven't really touched it or used it or, been in touch, you really need to circle around and do that to make sure that that does not happen to your assets. So what's the most important thing you can do to avoid this? Sit down, make a list of the various accounts, the various information, the account numbers, so that you have all of that information, and so that the beneficiaries or your heirs know that as well. Also a good idea to just check the Florida treasure hunt. If you're a longtime resident of the state of Florida, go online and check that, the floridatreasurehunt.gov site. Put in your name. You may be surprised at what comes up. You can also do that at other states. Other states have those types of websites. So maybe if you lived in Pennsylvania, then it would be a good idea to check, or you had parents or grandparents that lived in those states. Always a good idea to check that as well, just to make sure that there's not anything out there that got ignored and then wound up going back to the state. It's a much bigger number than you realize. Vanguard alone estimates that over a 20-year period of time, they escated over $200 million to the various states in the union. So some interesting stuff there. And how to solve it? Yeah, you just need to sit down and create that list to make sure that you are covered, or that people know where your stuff is, and make sure you're in touch with the various institutions that have these accounts, so they don't assume that you're dead. Because if they haven't heard from you for a few years, they're going to assume that. So make sure you do that as well, because you certainly wouldn't want those assets going to the state. I mean, that doesn't make any sense, right? Anyway, we will take a break. When we get back, we'll continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Howdy, friends. Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio WFLA Orlando. This segment of the program, we're going to talk a little bit about that ongoing trend that has been happening in 401ks and the like over the course of the past couple of decades. And the trend that we're talking about is, of course, the reduction in the number of funds that are available to you. I'm sure if you've been at the same place with the same 401k provider, you've seen those number of funds that are available to you shrink over that period of time. And the reason that they shrunk was there was a study done about 15 years ago now that said that the more investment options you have available, the more that overwhelms people. And when people are overwhelmed, there's a natural tendency to say, you know what, I'm not going to do anything. And so the study concluded that if you have an excessive amount of investment choices in a retirement plan, then you wind up with less participation in that plan. And obviously less participation when it comes to saving for retirement, saving for your future. Well, that's certainly not a goal of these plans. So there was a widespread shift over the course of the past 15, 20 years in response to these studies that ultimately kept reducing down the number of available investment options. The study back in 2004 concluded that for every 10 additional funds, so for every 10 additional funds, so going from 20 to 30, 30 to 40, 40 to 50, 50 to 60, you actually wound up finding participant rates declining by more than 1.5%. So obviously there was some correlation on that was studied and determined 15 years ago, which is why you then went on this huge trend of, okay, we're going to give less choice, less options within the 401k. But two things are very different now than they were back 15 years ago. One of which is automatic enrollment, and the other is all of these target date investment options that serve as default options. The numbers have changed quite dramatically. Back just 10 years ago, 40% of all 401k plans had automatic enrollment. Today, that number is 61%. Again, 10 years ago, only 58% of all 401ks offered target date type investment options. Today, it is 71%. It is estimated by the end of the year 2023, 4 out of $5 that are getting saved in an employer-sponsored plan, 80% are going to go to target date funds. Now, if you're a regular listener to the program, you know we're not a particularly big fan of target date funds. If that's your only option, then fine, have at it, but be careful because target date funds have a tendency to be set up much more conservatively than the number suggests. Also, there's no consistency among different target date funds. You could have a 2030 target date fund with one fund company, a 2030 target date fund with another fund company, and the allocation of stocks versus bonds versus cash may in fact be totally different. So it's so important to get under the hood and look at exactly what the investment allocation is in your target date option. The issue that we have with default options is just that. When it's a default option, yes, it's easier, but it may not be the best choice. And certainly when you look at target date funds, they are designed to be much more conservative than they should be for the particular year that somebody is selecting. It's almost like the years of a target date fund are marked to nearly be the end of your life. And the problem is that that's not at all what happens in today's world. If you're retiring at 65, guess what? Good Lord willing, you got another third of your life left. That's a lot of years in front of you that is important to keep track of how your investments are doing and not get too conservative. I digress on that. We've certainly spent prior shows on it. Let's come back to the research and the study that just came out. So against that backdrop where the old research showed that, hey, if you have more funds, it confuses people, So you wind up driving down participation rates. Now the pendulum really has sort of swung the other way. Perhaps it's gone too far in reducing choice, particularly when you look at the increase in automatic enrollment, when you look at the increased availability of target date funds. Now, for those, particularly the study concluded, for those that actually seek out a better option or a better course than just the default option, and we applaud those folks that do that for doing that, because that's smart to do. If you don't want to spend any time on it, you just want to take the default option, that's fine. But the default option is never going to be as good as it could have been. But the problem is that as these 401ks have shrunk the number of investment options, then those that seek to do more than the default option are also finding that their ability to do as well from an investment perspective is shrinking. So participants who chose not to stay in the default options tend to have more efficient 401k portfolios if they have a greater number of funds available. The study went further and concluded that if you increase the number of funds available from 10 to 30, you actually wound up boosting performance in a measurable way for those participants. So some interesting stuff here. Old studies, how things have changed, new studies. What's the bottom line for you? Look, if all your plan offers is a default option, that's fine. Make sure you look under the hood and determine exactly what that allocation in that target date fund is all about. And maybe push it out a few more years than what you might have originally planned, because those target date funds really are geared to be more conservative earlier on than people might reasonably expect. So that's number one. Number two, if you are doing your diligence and doing your homework and saying, okay, I want something more than just that silly default option, then you really got to look at the other funds that are available within your 401k. And ultimately, that's a question to ask your employer. There's no reason why your 401k plan can't add more funds. It's just that this whole study done 15 years ago said, oh, you got to go with less. Well, guess what? Okay, right? What's old is new again, I guess, is a popular expression. And that certainly seems to be the case when it comes to 401ks and the number of funds available to be offered. The reality is the cookie cutter default options are just that. But when it comes to your 401k and creating a real investment allocation, you want to ask your employer for more options, not less. If you've only got 10 funds available, if you only got target date funds available, you're not able to be as efficient as you could be from an investment perspective under that. So, bottom line, take a look at what you got. If you don't have that many individual funds, ask your employer to add some. They can. It's easy enough to do. You just need to talk to the plan manager, the plan fiduciary, and say, hey, we want some additional fund options in here. Let's add 10, let's add 20, let's add 30. At some point, it starts to get back to the diminishing returns. But the study concluded that around that 30 number is actually a pretty good number. So if you don't have that, I would encourage you to chat with your employer this time of year when you're going through that open enrollment process, all of that stuff, looking at all those employee benefits. Why don't you ask them to also make sure that they're looking at the 401k and making sure that it reflects today's reality and give you more choices. What's old is new again, right? More is not less. More is, in fact, more. With that, we will continue after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. On the program, we've covered a lot of territory, starting with, do you know where your money is? Seems like a simple question, but when you have the amounts of money every year that are getting escated to states because nobody is acknowledging the existence of those accounts. Nobody's checking in with their institution, or they're passing away and the heirs sort of don't really know where the assets are. That's a tremendous amount of money that's going to the state that maybe should be your money or maybe going to your heirs. So what can you do about it? Make sure you take the time to write a list. Write a list of all the different accounts, all the different institutions you do business with, and also make sure that you're touching base with them on a regular basis so they know that you're still alive, so they know that you haven't passed away, because if they think that, then they're going to kick it off to the state, and then it becomes the state's money. Granted, if you put the claim in on the state, it's your money again, but it's the state's money, and you've got to go through that process of claiming it. So make sure you do that. Last segment of the program, we were talking about the shocking reality that if you have more choice, that's good from an investment perspective. Some new data, a new study that's come out on 401ks sort of turns that conventional wisdom that all these plans have been operating under for the past 20 years on its head, in that if you have more funds available, you actually wind up getting better investment results for those participants who choose to do something more than just the default option. And as we've said many times on this program, if you're choosing just the default option, the cookie cutter option, you probably really can do better. You're just sort of being, dare I say it, lazy, not looking at the full spectrum of funds that are available. And at the end of the day, the default option is always just that, cookie cutter, not really going to get you as good of a potential return as you could if you were to design your own investment allocation. So make sure you talk to your employer about, hey, how come there's only 10 funds in this 401k? There's a new study out there that says we need to have more, and the ideal number is right around about 30. So make sure you've got some options in your 401k. You know, last week or maybe the week before on the program, we were talking about conversations that were taboo. We'll be happy to talk about politics or religion around the dinner table, but heaven forbid if we talk about finances. And so we were encouraging folks to start to have more open conversations about finances. The other interesting conversation that we would comment on is that you've got the holidays coming up, and rather than engage in a political or religious discussion around the turkey table, maybe you think about it in different regards. One of the things that most people do here at the end of the year, well, for most people, that's when they do a lot of their charitable giving. They think about what they're going to do for different charities. And so we would encourage you to maybe incorporate that conversation. You don't want to deal with my suggestion last week of talking about finances at Thanksgiving. Well, that's fine. Maybe you can get somewhere halfway in between and avoid the politics and the religion, but instead perhaps talk a little bit about charitable giving and what that means for your family. Certainly at Thanksgiving time, it's a time to be thankful, and I think it's important to also think about those that perhaps are less fortunate than you may be, and to look at that from a charitable perspective. And so one of the articles that we posted this past week on Facebook dealt with 20 questions that you should be asking when it comes to charitable planning, charitable giving. Now, we're not going to roll through all 20 of them. That's why we put the article up on social media. But some important things to be thinking about as it relates to charitable giving. The reality is it's that time of year, right? The end of the year is when a lot of people do their charitable giving. Sadly, there's less of a benefit on that for many Americans because of the change in the tax return. Obviously, going to a higher standard deduction means that you are not going to get as much of a direct benefit for making those charitable contributions as you might once have done. It's one of the reasons why we suggest the notion of a qualified charitable distribution. If you've got to take a required minimum distribution, have that required minimum distribution go directly to the charity. Don't have it come to you and you write the check. That's not going to work. You've got to have that required minimum distribution go directly from the financial institution to the charity, And then ultimately, you do wind up getting some direct tax savings for that charitable gift. But certainly as a family, something to talk about at Thanksgiving time. Some of the more important questions to ask is, in what form and fashion do you want to do that? Do you want to do more now or an amount along the way? How involved do you want to get with the organization that you're contributing to? We certainly would encourage you to do some investigation on the organization just to make sure that it's legit, that you're familiar with it, that you're comfortable with the causes that it supports, because ultimately, then once you write that check to charity, it's out of your hands, and charity's free to do with it as it wishes. So make sure that their causes and goals and missions align with where you want your money to go. And also, I think it's important to do an on-site visit to your charitable organization of choice, just to make sure, kick the tires, so to speak, a little bit on it, so that you can make sure that when you make a charitable contribution, that it's being used for the purposes that you want. Maybe even decide that you want to be a volunteer. There's some other things to be thinking about as well when it comes to charitable donations. So some good family conversation there. Maybe there's something, an asset that nobody really wants to have anymore. Maybe it's some property up north or some vacant land somewhere in Florida that you look at it and say, well, you know what? No one's going to use that. It's landlocked. It's nothing really that's going to be anything that anybody's going to use. Maybe that's something that might be better served by giving it to a charity. So think about those types of assets that maybe nobody wants, or assets that have a high level of appreciation. Another great tax planning approach is to take an asset that has a lot of appreciation, and rather than sell that and you have to then pay that capital gain on your tax return, give that to the charity in its current form. The charity, as the recipient of that gift, gets your cost basis, but because a charity is, after all, a charity and doesn't pay taxes, then they are able to avoid the capital gain that would otherwise be applicable on the sale of that investment. So certainly a great way to do it in terms of efficiency and looking at your assets to see, okay, maybe there's some that we want to use to give to charity over others than just simply writing a check. So lots of questions to be thinking about as it relates to charitable giving. Certainly a great conversation to have around the holidays, particularly at Thanksgiving, so that you can decide where that money is going to go. So there's about 20 questions on it, and it's a great article, so we encourage you to check it out on our Facebook. So some interesting stuff on that. In terms of other topics, we just want to reiterate what we talked about at the top of the show. Remember, for next year, 2020, the 401k limits have increased. So that's great news. So make sure that you adjust your 401k contribution to reflect those higher limits. If you're over 50, you can put in a total of $19,500 if you're under 50. If you're over 50, you can put in an additional $6,500 on top of that for a total gross contribution of $26,000. Unfortunately, no changes on the IRA this year, but good news for savers through their employer. The amount that you can put away there has increased by a little chunk. So good information on that as well. Well, the music means we got to wrap it up and get on out of here, and we will do just that. We will be back next week, though, to continue the conversation as we do each and every week here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando.